Welcome to the deep dive. Ever wonder where company names come from? Take Roku, for instance.
Mm-hmm.
It sounds pretty techy, right? But Roku, it's actually Japanese for six.
Oh, interesting. Six. Why six?
Turns out it was founder Anthony Wood's sixth company. And, this guy isn't new to the scene. He invented the DVR, founded Replay TV.
Right. He's got some serious tech history there, a real pedigree.
Exactly. So today we're diving deep into Roku Inc., ticker ROKU.
And we're using a sort of Buffett-style value investing lens,
Yeah.
looking at analysis mainly from May 8th, 2025, plus some of the recent bits. The mission really is to figure out if Roku looks like a compelling opportunity.
Right. We want to understand the business, the financials, management, market position, the whole picture.
Yeah, see if it's building lasting value, especially that big shift they made, from hardware to focusing more on their platform. We really need to unpack what that means for their future.
Okay, let's do it. We'll look at their business model, where they sit in this crowded streaming world, management quality, financial health, what the market thinks.
Ownership, risks.
So, yeah.
Yeah, the works. And just a reminder, all the sources we're digging into are linked in the description if you want to go deeper yourself.
Perfect. So Roku, it feels like they're everywhere now. How did they get from that first Netflix box to where they are today?
Well, it started back in 2008, like you said, with that first device really built for Netflix streaming. Then came the IPO in 2017, and their ambition just grew massively.
Their goal now is what? To power every TV?
That's the stated mission,
Yeah.
Power every TV in the world. It's ambitious, to say the least.
No kidding. And their business model, I feel like it's changed quite a bit from just selling those little boxes.
Oh, absolutely. That's the crucial evolution. They've shifted focus from primarily selling the hardware, the streaming players, and now their own Roku TVs, to really doubling down on the platform segment.
Okay, the platform segment, that's where the money is, presumably. Higher margins.
Exactly. That's where the potential for more sustainable, higher profit margins really lies.
So what drives that platform revenue? Break that down for us.
Sure. There are a few key streams. Advertising is the big one. Video ads, display ads you see on the interface, sponsorships, and increasingly programmatic advertising.
Programmatic, buying and selling ads automatically, right?
Yeah, in real time. Super important. Then there's content distribution, basically. They get a cut when you subscribe to services like Netflix or Hulu through the Roku platform.
Ah.
And finally, they license their Roku operating system, the OS, to TV manufacturers like TCL, Hisense. They pay Roku to use its software in their smart TVs.
You mentioned programmatic advertising is increasingly important. Why the focus there?
Well, it's efficient, It opens the door to more advertisers, even smaller ones, using their self-serve Roku Ads Manager. It's also strategic, especially as things like third-party cookies fade away. Roku has that direct user relationship and data.
Makes sense. But I saw something about that maybe impacting their margin guidance slightly.
That's a sharp observation. Yeah, the shift towards programmatic is one factor they mentioned that might slightly moderate the platform gross margin outlook for this year. So there's maybe a bit of a trade-off there between scaling up ad volume and the profit per ad, something for investors to watch.
Interesting nuance. Okay, but they're still selling the hardware, right? The sticks, the TVs.
Oh, definitely. The devices segment is still very much part of the strategy. They've got new streaming sticks for 2025, smaller ones, and HD for $30, 4K for $40, designed to plug right into the TV's USB for power.
Handy.
Yeah. And they still sell the standalone boxes and their own Roku-branded TVs. They sold over 1 million of those TVs in 2024. And the new 2025 ones even have mini LED backlighting for better picture.
But the understanding is they don't make much money, if any, on the hardware itself.
That's absolutely critical to understand. The devices segment usually runs at very low or even negative gross margins.
So it's a loss leader.
Pretty much. It's deliberate. They see the hardware as the main way to get people into the Roku ecosystem, to get that Roku OS onto screens. That growing user base is what feeds the profitable platform segment. Think of it like a user acquisition cost.
Get the users first, monetize them later through the platform.
You got it. And the Roku OS is central to all this. It's consistently the #1 selling TV operating system in the US, Canada, Mexico. Q1 2025, it was in nearly 40% of smart TVs sold in the US.
Wow.
Yeah, and its big selling points are ease of use, finding content easily, bringing everything together in one place for you.
And the Roku channel, that seems like it's becoming a bigger deal for them.
A much bigger deal. It's grown significantly. In Q1 2025, it was the #2 app on Roku in the US by engagement, #3 globally. Streaming hours on the Roku channel jumped 84% year over year in Q1.
84%? That's huge.
It is. And their investment in Roku Originals, their own exclusive content, is clearly aimed at drawing even more viewers, specifically to the Roku channel. It's becoming a destination itself.
And for advertisers wanting to reach all those eyeballs.
They have tools for that. Roku Ads Manager for self-serve campaigns, plus those programmatic capabilities we talked about. With the decline of third-party cookies, Roku's first-party data, what they know about their users directly, becomes really valuable for targeting ads.
Okay. Now, what about this Friendly TV acquisition I read about? Where does that fit in?
Ah, yes, Friendly TV. That's a strategic move to bulk up their subscription and live TV offerings. They agreed to buy it for $185 million. Some cash up front, some based on performance.
And Friendly brings?
It brings over 50 live TV channels, like A&E, Hallmark, History Channel, popular stuff. The idea is it strengthens Roku's own subscription base and appeals to cord cutters who still want that live linear TV experience, but maybe cheaper.
So making the Roku platform stickier, keeping users within their ecosystem.
Exactly. They expect the deal to close in Q2 2025 and actually add to their adjusted EBITDA in its first full year. So financially motivated too.
Okay, so pulling this all together, what's the core value proposition here? For consumers, content folks, advertisers.
Right. For you, the consumer, it's easy access, tons of content aggregated simply, usually on affordable hardware or built into your TV. For content providers, it's access to a huge audience and tools to make money. Historically, Roku was seen as pretty neutral here. And for advertisers, it's targeted reach, good measurement tools, and insights from the Roku Data Cloud.
But you said historically neutral. With Roku making its own shows now and selling its own TVs, does that change things? Does it make them a competitor to their partners?
That's a really important dynamic to watch. Yeah, as they invest more in the Roku channel and push their own TVs, they do start competing more directly with some content providers and TV manufacturers who are also their partners.
So they have to walk a fine line there.
Definitely. Managing those relationships carefully is going to be crucial to keeping the whole ecosystem healthy.
Okay, really good context on the business. Let's pivot to the people running the show. Who's leading Roku?
At the top, you still have the founder, Anthony Wood, as CEO. We mentioned his background, DVR, replay TV. His focus now is very much on platform growth and getting to profitability.
And the team around him.
It's a mix of that founding vision and some pretty heavy hitters from media and tech. You got Dan Jetta as CFO. He came from Amazon, specifically overseeing finance for their digital video and ads.
Okay, relevant experience.
Very. Then there's Charlie Collier, president of Roku Media. He used to be CEO of FX Entertainment, and before that, president of AMC Networks during the Mad Men, Breaking Bad, Walking Dead era. So deep media chops.
Wow, yeah, big names.
And Mustafa Ozgen heads up devices, product and technology, and Gil Feiksberg handles subscriptions, partnerships, and corporate development. So a blend of experience across the key areas.
Got it. And what's their big picture strategy look like now? What are the priorities?
It seems to be focused on a few core pillars. One, really pushing platform monetization, more programmatic ads, growing subscriptions built through Roku, especially with Friendly TV coming in, and using that home screen real estate smartly.
Okay.
Two, driving engagement, using AI for better content suggestions, features like the Sports Zone they launched, and continuing to grow the Roku channel's viewership. Three, device innovation, keep refining the sticks, the TVs. They even mentioned a smart projector at some point.
Interesting.
Four, international expansion, pushing into markets like Canada, Mexico, the UK. And five, and this is a big one, achieving positive operating income for the full fiscal year 2026. That signals a real push for operational discipline and profitability.
Right, that profitability target. How are they spending money to achieve all this? Where's the capital going?
Well, significant chunks are going into R&D. That was about $185 million in Q1 2025, up slightly. And sales and marketing is even bigger, nearly $224 million in Q1, up 11%. That's about acquiring users, promoting the platform.
And acquisitions like Friendly TV.
Exactly. That $185 million is a clear strategic M&A move. They also bought Ataxu, an ad tech company, back in 2019 to boost their capabilities there.
But are these investments actually generating good returns? You mentioned profitability challenges.
That is the critical question, especially from a value perspective. Right now, Roku's return on invested capital, their ROIC, is actually negative. And it's below their weighted average cost of capital, or WACC.
Which means?
It means the money they're investing isn't currently generating returns high enough to cover the cost of that money. So technically, that growth could be destroying economic value in the short term. It's a major red flag for value investors.
Ouch. That doesn't sound great. Is there any positive spin there?
Well, their reported 3-year ROIC, which looks at returns on more recent investments, is actually surprisingly high. That could suggest newer investments are performing better, but the overall current ROIC being negative and below WACC is the headline figure that needs serious improvement. Capital efficiency is a big question mark.
Definitely something to watch closely. Now, how aligned are management's interests with shareholders? What about insider ownership?
This is another area that raises some questions. Direct insider ownership is reported as quite low. Often cited figures are around 0.6% to maybe 1.2%.
That is low for a founder-led tech company.
It is. And what's also noteworthy is the pattern of insider selling recently, in the months leading up to May 2025. CEO Anthony Wood has sold shares multiple times, and other key execs like Matthew Banks, Charlie Collier, Dan Jetta, Gilbert Fuchsberg, they've also sold shares.
How should we read into that? People sell for lots of reasons, right?
True. Could be diversification, taxes, personal reasons. But consistent selling by multiple top insiders, especially the CEO, can be a yellow flag for value investors. It might suggest they don't see huge upside in the near term, or maybe anticipate challenges. You typically find more detail on their compensation packages, which can influence selling in the proxy statement.
Okay. And governance-wise, how is the company structured? Any red flags there?
There are a few things common in tech, but maybe not ideal for shareholder rights. They have a classified board, meaning directors have staggered terms, making it harder to change the board quickly. There are limits on shareholder actions, no cumulative voting for directors.
Standard anti-takeover type stuff.
Yeah, kind of. And perhaps the biggest thing is the dual-class stock structure. Insiders, mainly Wood, hold Class B shares that get 10 votes per share, compared to 1 vote for the Class A shares the public holds.
So insiders maintain voting control even without majority ownership.
Exactly. It concentrates power significantly. And you mentioned customer complaints earlier.
Yeah, I saw something about the Better Business Bureau.
Right. The BBB site shows several hundred complaints over the last 3 years. Common themes were billing issues, problems with remotes, loud commercials, that's a classic one-app, glitches, subscription clarity.
So some friction points with users.
Seems so. While every big company gets complaints, a high volume or consistent pattern can point to underlying operational issues worth noting.
Okay, super helpful on the management and governance side. Let's dig into financials now. How has Roku performed historically? You mentioned revenue growth.
Yeah, top-line growth has been really impressive. Revenue went from like $1.8 billion in 2020 to over $4.1 billion in 2024. And Q1 2025 continued that trend, up 16% year over year to just over $1 billion.
But the bottom line hasn't kept pace.
Not consistently, no. They actually were profitable on a net income basis in 2021, but that seems like an outlier. FY 2024 saw a net loss of about $129 million. Q1 2025 was also a net loss, around $27 million, though that was better than the loss in Q1 the year before.
So improving, but still red ink on a GAAP basis. What about adjusted EBITDA?
That looks better. They did $260 million in adjusted EBITDA for FY 2024, $56 million in Q1 2025, and they're guiding for $350 million for the full year 2025.
But adjusted is the key word there, right? It excludes stuff.
Crucially, yes.
Yeah.
You always need to remember what's being adjusted out. A big one for Roku is stock-based compensation, which they project will be around $410 million in FY 2025. So that positive adjusted EBITDA doesn't mean they're generating cash profit after all expenses.
Got it. Let's look closer at profitability, those segment margins you mentioned earlier.
Right. The contrast is stark. The platform segment as subscriptions licensing has strong gross margins. Q1 2025 was 52.7%, and they guide around 52% for the full year. Healthy.
But the
Devices segment gross margin in Q1 was negative 13.8%. They're guiding for negative 10% in Q2. So losing money on every device sold, essentially.
Wow.
Which brings the total company gross margin in Q1 to about 43.6%. It really underscores how vital that high-margin platform growth is to offset the hardware losses. Their overall operating margin improved, but was still negative 5.7% in Q1, and net margin was about negative 2.7%.
So the whole strategy hinges on the platform economics working out long-term. How's their balance sheet look? Do they have cash to weather storms?
Yes, the balance sheet looks quite strong, actually. As of the end of March 2025, they had about $2.26 billion in cash and equivalents.
And debt.
Total debt is relatively low, around $600 million. So they have a very healthy net cash position of roughly $1.76 billion. Yeah. Debt to equity is low, around 0.24, and their current ratio is strong, over 2.6.
So plenty of financial flexibility.
Definitely. Gives them room to maneuver, invest, handle downturns.
What about cash flow? Are they generating cash from operations?
They showed a big jump in operating cash flow in Q1 2025, $138.7 million, up from about $47 million the year before. A lot of that was driven by improvements in working capital, managing inventory and payments better.
And free cash flow?
Free cash flow was also positive in Q1, nearly $300 million. But, one quarter doesn't make a trend, especially with working capital swings. For the full year 2024, FCF was $213 million. The key question is sustainable FCF from operations after covering stock comp realities and essential capital expenditures.
Right. And looping back to that ROIC versus WACC point, remind us why that's so critical.
Because it's the fundamental measure of whether a company is creating or destroying economic value. ROIC tells you the return on all the capital invested, debt, and equity. WACC is the required return to satisfy investors and lenders.
And Roku's ROIC is?
Trailing 12 months, it was negative 14.76%. Their WACC was estimated around 15.21%. So ROIC is significantly below WACC.
Meaning current investments aren't clearing the hurdle rate.
Exactly. From a pure value creation standpoint, that's not sustainable long term. Growth needs to generate returns above the cost of capital. That weirdly high 3-year ROIE figure needs more digging, but the current picture is concerning on this front.
Okay. So revenue growth, yes. Balance sheet strong, yes. But fundamental profitability and return on capital, still major question marks.
That sums it up pretty well. The recent working capital improvements are good, helping OCF and liquidity, but the core operational profitability needs to drive sustainable FCF and get that ROIC up.
And quickly, dividends or buybacks, anything for shareholders there?
Nope. No dividends, no recent share repurchase programs. Pretty standard for a growth-focused tech company that isn't consistently profitable yet. They're reinvesting everything back into the business.
All right, that covers the financials well. Let's move on to market sentiment. How is Wall Street feeling about Roku these days?
It's mixed, I'd say. Cautiously optimistic might be the term. The analyst consensus rating tends to hover around moderate buy or outperform.
But the price targets are all over the place.
Exactly. Average targets might be in the $84 to $92 range.
Yep.
But you see individual analysts anywhere from $60 on the low end up to $130 on the high end. That wide range really tells you there's a lot of disagreement and uncertainty about where things are headed.
What happened after their last earnings report? They beat estimates, right? But the stock went down.
They did beat Q1 estimates, yeah.
Yeah.
But stock dropped afterwards. It seems the market keyed in on slightly softer than expected revenue guidance for Q2. And just general nervousness about the macro environment, the ad market, even though Roku reaffirmed their full-year guidance.
So future outlook concerns weighed more heavily than the past beat.
It appears so. Shows how sensitive the market is to growth expectations right now.
Any other sentiment indicators? Short interest, options market.
Short interest is floating around 5–6% of the shares available for trading. Days to cover is low, about 1.4. So some people are betting against it, but it's not an extreme level of short interest suggesting imminent collapse or anything.
Yeah.
The off-exchange short volume ratio was noted as being relatively high, which could imply some more strategic shorting. Options market. The put-call ratio is near 1, which suggests sentiment among options traders is pretty balanced between bullish and bearish bets.
So no strong conviction either way from those indicators. Okay, let's look at ownership. Who holds the shares?
Institutions dominate. Somewhere between 82% and 85% of Roku stock is held by big institutional investors.
Like who? Any big names moving in or out?
FMR LLC, the parent of Fidelity, is the largest holder and actually increased its position recently, which signals some confidence. Vanguard is another huge holder, relatively stable, or maybe a slight increase. On the other side, ARK Investment, Cathie Wood's firm, has reduced its stake. BlackRock also trimmed its position.
So even the big players have differing views.
Seems that way. A mix of increased conviction from some and decreased from others.
And insider holdings, just to reiterate.
Still very low direct ownership by insiders. And that pattern of consistent selling by executives, particularly CEO Anthony Wood, continues to be a point investors might look at when thinking about alignment.
Right. Okay. We have a good sense of the market view and ownership. Now, the crucial part, risks. What are the big challenges Roku faces? Let's do a sort of SWOT analysis, focusing on the threats and weaknesses.
Competition has to be number one, or near it. It's intense. You've got Amazon's Fire TV, Google TV, Apple TV, all huge companies with deep pockets and massive ecosystems.
Plus the TV makers themselves.
Exactly. Samsung's Tizen OS, LG's Web OS. They're direct competitors for eyeballs on the TV screen. And now streaming services are building their own ad tech, competing for ad dollars too. Plus, the North American market might be getting saturated. Where does new user growth come from?
Good point. What about the economy? Macro headwinds.
Definitely a risk. People cut back on buying new devices or maybe premium subscriptions when money's tight. And the ad market is notoriously cyclical. If the economy tanks, ad spending usually pulls back, and that hits Roku's platform revenue directly. Management even acknowledges this uncertainty in their forecasts.
And the profitability risks we discussed. Execution risk.
Huge. Can they actually hit that 2026 target for positive operating income? There's pressure from those negative device margins and maybe even platform margins if the ad mix shifts unfavorably. And fundamentally, that ROIC below WACC issue needs fixing for long-term health. Execution is key.
Then there are those tariffs. How big a deal are they?
Potentially a very big deal. The 2025 U.S. tariffs on semiconductors, microchips, lithium-ion batteries, those hit Roku's manufacturing costs directly for their sticks and TVs.
They said it's impacting Q2 device revenue, right?
Yeah, they cited tariffs as one reason for the projected decline. It also indirectly affects sales of partner TVs if they get more expensive, and could dampen ad spend if the broader economy suffers from trade friction.
Are they doing anything about it?
They mentioned diversifying manufacturing, passing on some costs through small price increases. They sound confident they can manage it, but tariffs are inherently unpredictable. If they stick around or expand, the impact could be significant.
Okay. Regulatory risks. Privacy.
Always a factor in tech. Evolving data privacy rules like GDPR in Europe or CCPA in California mean higher compliance costs. More importantly, they could restrict how Roku uses data for ad targeting, which is core to their ad business value.
Any specific issues?
There was mention of a class action lawsuit related to child privacy connected to the friendly TV service they're acquiring. That means potential legal costs and maybe reputational damage. Privacy is a growing area of scrutiny.
And finally, dependence on partners, content providers.
Yeah, that's key too. Roku doesn't own most of the content people watch. They rely on having apps like Netflix, Disney Plus, Max available. If a major provider pulls their app in a dispute or demands significantly worse terms, it hurts the platform's value proposition for users.
So, summarizing the risks. SWOT style. Weaknesses include the ongoing net losses, negative device margins, that ROIC problem, heavy reliance on ad revenue, low insider ownership, and some governance concern.
Right. And threats are the intense competition, those tariffs, potential macro downturn, execution risk on profitability, rising content costs, potentially squeezing partners, and the regulatory landscape.
But there are opportunities too, right? Strength.
Definitely. Strengths: market leadership in North America, strong brand recognition, large active user base, growing platform revenue, decent ad tech, network effects, opportunities. Huge CTV ad market still growing, cord-cutting trend continues, international expansion, new ad products, integrating friendly TV using AI for personalization, lots of potential upside if they navigate the risks.
Okay, that's a really thorough breakdown. So we've covered the business, the management, the financials, market view, ownership, and the risks and opportunities. Let's try to wrap this up. Key takeaways.
Well, Roku's definitely carved out a strong market position, no doubt, especially in North America. But they face pretty significant hurdles, mainly around achieving consistent profitability and fending off giant competitors.
That shift to the platform model is everything then.
It's absolutely crucial, but success there depends on keeping those platform margins high, controlling costs across the board, and, critically, getting their return on invested capital above their cost of capital. That ROIC WACC issue is the big flashing light for long-term value creation.
And the tariffs and macro picture just add more fog.
Exactly. They introduce external uncertainties that are largely outside Roku's control but could definitely impact their performance.
So after all this, the big question we start with, is Roku a value trap, looks cheap but has fundamental problems, or is it potentially one of those Buffett-style gems in the making, maybe going through a rough patch?
That really is the million-dollar question, isn't it? Or maybe billion-dollar, given the market cap.
So here's something provocative to leave you with. Given Roku's huge market share, the fact that streaming isn't going away, could these current struggles, the losses, the low ROIC, just be temporary growing pains? Are they headwinds that will eventually clear, revealing a dominant, profitable company?
Or are the competitive pressures just too immense? Is that low return on capital a sign of a fundamentally difficult business model in this space, making sustainable economic profit really hard to achieve?
What needs to happen? What specific things have to go right for Roku to truly unlock that potential and generate real sustainable economic value for shareholders?
That's the puzzle for you to think about. What needs to change or improve?
For more deep dives like this one, definitely subscribe to the Stock Analytics AI YouTube channel.
Yeah, please do.
And let us know what you think in the comments. What's your take on Roku's path forward? Can they achieve sustainable profitability? How strong is their competitive moat against the giants? We'd love to hear your perspective.
Just a final reminder. This analysis was based on public information and research available as of May 8, 2025. It's purely for informational purposes.
Absolutely. Not financial advice. Always do your own thorough research and due diligence before making any investment decisions.
And we should also mention that AI assisted in pulling together and summarizing the information we discussed today.